Today, mortgage delinquencies tick higher as more high LVR loans are written. Hello again, it's Martin North from Digital Finance Analytics, working on the latest post covering finance and property news with a distinctively Australian flavour. Genworth, the Lenders Mortgage Insurer, released their third quarter results today. Their statutory net profit after tax in the third quarter 2019 was $25.1 million, compared with $19.6 million in the third quarter last year. And their underlying net profit after tax is $26.5 million compared with $20.4 million a year ago. And Genworth said that the third quarter 19 performance was solid, with gross written premiums up 24.4% from growth in, quote, our traditional lenders mortgage insurance, driven by increased volumes in high loan-to-value lending by our lender customers. Now, the delinquency rate increased from 0.55% in the third quarter 2018 to 0.6% in the third quarter 2019. And they say that this was driven primarily by an increase in delinquency rates across most states, particularly though in Western Australia, New South Wales and Queensland. And the increase also reflects the continued extended ageing of delinquencies due to slower loss management processing by lenders. And that was first called out back in financial year 18. Encouragingly, they say, signs of faster processing by some lenders has emerged this quarter. And indeed, we've seen evidence of that, particularly in Western Australia. The delinquency rate remained flat between the second quarter 19 and the third quarter 19, and new delinquencies were down slightly third quarter 19 to 2,622 versus 2,742 last year, and is in line with favourable trends usually experienced in the third quarter, as new delinquencies reduced from 2,853 in the second quarter. Cures improved from 2,378 in the third quarter 18 to 2,439 in the third quarter 19, as lender customers started to emphasise remediation of ageing delinquencies. However, the cure rate is still lower than it was back in 2017. And the number of paid claims was up the third quarter 2019, 361, versus third quarter 18 at 320, although the average pay per claim decreased from $115,700 in the third quarter 18 to $97,900 in the third quarter 19. And they said this decrease is a result of the stabilisation in the mining areas. However, the average paid per claim remains elevated as challenging market conditions remain across areas such as Perth and its specific sub-regions. The ageing also highlights the length of time it takes to get into difficulty, given the peak in loan written back in 2013 and 14. And portfolio delinquency remained relatively steady over the quarter. Following seasonal trends, despite the overall stability, impacts from ageing delinquencies continue, but early signs of faster loss mitigation processes by lenders are emerging. The 2006 and prior book year performances were affected by higher proportions of low doc lending, which reduced significantly in 2009 following policy changes and decommissioning of low doc products in the latter part of 2009. Historical performance of 2008 and 9 books was affected by the economic downturn experienced across Australia and heightened stress experienced among self-employed borrowers, particularly in Queensland, which has been exacerbated by recent natural disasters. In the 2010 to 12 years, delinquencies were lower, driven by stronger credit policies, but deteriorated in 2014. And books since then have reflected the downturn in mining regions, resulting in ongoing economic and housing market challenges. But the most obvious issue ahead is the rising level of delinquency in New South Wales. This will be one to watch in coming quarters, alongside a potential rise in the proportion of high loan-to-value loans being written now, thanks to the APRA loosening. And yes, I know interest rates are very low at the moment, but nevertheless, households, it seems to me, are being lured into the market, and this data continues to highlight the stresses and strains in the mortgage sector. And I have a feeling that lenders mortgage insurers are right in the front line. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.